Let's get your trading day started. Live from New York City this morning. Good morning, good morning. Your equity market looking pretty good. Up 0.5% on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, equities heading towards a big month of gains. As one Fed official signals he's most likely done, bets growing, rate cuts are just around the corner. We begin with the big issue, the hawks sounding like doves.
It's a dovish message.
Pretty strong pivot from Fed members yesterday.
That is quite key. That is quite a game changer.
This is definitely adding to the expectations of the market for a cut.
What will be key now is whether Powell reinforces that.
They're going to have to sort of balance the message.
They're trying to kind of thread the needle here.
There's an element of we don't want the market to get too ahead of itself.
If we were to just rewind a few weeks ago, the tune from the Fed was very much about higher for longer.
The trend is very clear.
We do have a slowing U.S. economy.
Inflation is probably coming down.
There is clear evidence that the labour market is starting to loosen.
The Fed is getting what they want.
The Fed is basically out of the way here.
The Fed is likely done hiking.
There's an element of this is our best guess and we're changing it as data evolves.
We've got a couple of important data points in the next few weeks.
And some soothing words from Governor Waller. Boom, bond market rally, yields lower. Let's have that conversation. Crossmarks Bob Dole, Richard Bernstein of RB Advisors. Gents, great to catch up with you. Bob, first to you. We heard from Governor Waller a suggestion, no more hikes. Governor Bowman saying something completely different. Why did we ignore one and listen to the other?
Great question. I think investors are confused, and therefore, whatever the latest move has been, they accentuate that on that side. But I think it's pretty clear the Fed doesn't know what they're going to do next, and therefore we investors probably don't know either. Look, the Fed is either done or very close to done. But I think the debate will be how many months is it before they contemplate lowering rates? How weak will the economy be when they actually do it? And where will the inflation rate be? A lot of tough questions
that haven't been answered, and yet still massive moves in this bond market. The 10-year's gone from 5% to 4.30. The 2-year's gone from 5.26 to 4.67. Richard, do we have selective hearing in the Treasury market?
I think, Jonathan, we do to some extent. You know, the GDP number that came out this morning showed the strongest nominal economy in 20 years outside of the immediate post-pandemic, surge. This is the strongest quarter we just had in 20 years in the nominal economy, but yet everybody is convinced that rate cuts are on the horizon, and some people are still forecasting recession. So that would imply an immense collapse in the U.S. economy, something that we've never seen without calamity like a pandemic or 9/11 or something like that. So I think people are being quite optimistic here.
Bob, let's talk about that optimism, the happy talk. The consensus view at the moment seems to be below trend growth, no recession, but you'll get your rate cuts by equities. Bob, what's the reality check for you this morning?
That PE is approaching 20 again. That makes me nervous. And every time I turn around, estimates for the fourth quarter or next year are getting cut. That doesn't give me a lot of comfort that I should buy stocks at 4,600.
So 45.84. Have you still got a range of 42 to 4,600?
Yes, and when we get to 42, I get interested in buying. And obviously, we dip to the low 41s. As we approach 46, I'm a trimmer.
Beneath the surface, Bob, what do you like?
So I think that having stocks in your portfolio that have good cash flow characteristics, have reasonable earnings predictability, reasonable earnings persistence, those kinds of things tend to work in the uncertain world which we find ourselves.
Doesn't that take us to the Magnificent Seven?
Yeah, you got to own some of them. I'm not disagreeing with that. Valuation's always one of the variables we have to look at, but relative to what they're able to produce and the consistency of what they produce, several of those stocks are not all that expensive. Our favorite is Microsoft among that 7.
Richard Bernstein, take the stage. Richard's words, magnificence beyond the Magnificent Seven. Talk to me, Rich, about that magnificence.
Right. So John, our story is basically that one could understand the Magnificent Seven and their dramatic outperformance if they were somehow unique. If there were only 7 growth stories in the world, it might make a lot of sense to see what we're seeing. The unfortunate reality is that there are tons of growth opportunities. In fact, there are many stocks whose earnings growth is far surpassed that of the Magnificent Seven, whether you look on a historical basis or on a forecast basis, suggesting that there's a broad range of growth opportunities, both in the United States and outside the United States. So that says that the rush towards 7 stocks is really pretty irrational and is really just a momentum market, not unlike, speculative momentum bubble type markets we've seen before.
That was true 12 months ago, and here we are staring at double-digit gains year to date. What changes that?
I think what's going to change that, if we're right, and if the economy is not falling into recession and the Fed isn't going to start cutting hand over fist, which seems to be the consensus, and there's not going to be tons of liquidity flowing back into the financial markets and financial conditions start to tighten again, that would end, history says that would end the Magnificent Seven. We saw that in 2022. Right, where the Fed was tightening and Magnificent Seven were down 40, 50, 60%. So I don't see why people would be so confident that couldn't possibly happen again.
To your point, that word confidence, there is tons of confidence that next year the rate cuts begin. Your 2-year is down another 7 or 8 basis points at the front end to about 4.66. Mike McKee has the latest on the Fed speak. Morning, Mike.
Good morning, John. Well, this is the thing that moved the markets yesterday, and that was, as you were mentioning, Christopher Waller suggesting that maybe rate cuts could come next year, because Fed officials have been pushing back on that idea for quite some time. Here's what he sees. He's encouraged, he says, by what they've learned in the past few weeks. Something appears to be giving, and it's the pace of the economy. And here's what he means by that. Never mind the 5.2% revision, upward revision today to third quarter growth. It's the fourth quarter that matters now, and the Atlanta Fed GDP, we're using that as a proxy for pretty much everybody's forecast, looks like it's down to 2.1%, which means a halving of growth, more than a half of growth. And the idea is that would bring down inflation. I do have some good news for Bob Dahl, though, and he said he doesn't know whether he wants to invest right now. Corporate profits in the third quarter, first time we get that is in this second release, and they were up 3.3%. compared to just 0.2% in the second quarter. So there's some good news. You were talking about Mickey Bowman and whether she was speaking something different from Chris Waller. She's talking about the idea that maybe inflation could go back up, in which case she'd support rate increases. Not that rate increases have to happen. She says we should keep in mind the historical lessons and risks associated with prematurely declaring victory in the fight against inflation. And here's what she is talking about. You can see that economists have tended to overstate inflation. This is PCE inflation, which we get tomorrow. It's the Fed's measure of inflation, the one that they benchmark their 2% rule to. And the markets have come in much higher than that in recent weeks. And you can see the consumers, the yellow line there, they look like they're going to see inflation almost double in the next month or so, whereas the consensus sees it dropping. So there's a lot of uncertainty about what's going to happen with inflation, even if the economy slows. So that gets back to, I don't have anything more definitive than what you guys were saying, is nobody really knows at this point.
It's over to you, Chairman Powell, on Friday. Mike McKee's going to continue covering some of the incoming Fed speeches you can expect between now and then. Chairman Powell in Atlanta, I believe, this coming Friday, just a couple of days away. I want to return to that line from Governor Waller. Something appears to be giving, and it's the pace of the economy. Richard Bernstein, why is the Q3 boom still relevant to you, given what Governor Waller's saying now?
Well, I think, John, it's nobody expects the third quarter to be repeated. I mean, that would be incredible to have that happen. But I think the important thing to think about is, Michael mentioned this very briefly before, corporate profits are starting to rev up. The profit cycle has troughed. And if the profit cycle is troughing, and on S&P basis, we're going from about minus 10 to 15% to what could be 10 to 15% profits growth in 2024. If that happens, we should expect the labor markets to get tighter, not easier. We saw the weakness in the labor markets. Whatever weakness we saw was during a profits recession. That profit recession, as Michael just pointed out, is over. We should expect hiring to pick up as we go out of that profits recession towards a profits expansion. Labor market's already tight. It's not going to get easier. It's just going to get tighter, which will put pressure on wages, which will put pressure on inflation. So I think, whether it's 8% nominal GDP or 5% nominal GDP, whatever you want to put in there, the reality is the economy is not dying. And I think that's the important point. And I think inflation pressures will remain, maybe to a lesser extent, but they will remain. And I think they'll be kind of stubborn.
Bob Dole, what's your response?
If nominal GDP is in the 5 to 8% range, I agree with Rich. That makes things tight. It puts pressure on the inflation rate. It causes the Fed not to contemplate cuts, but maybe raise rates again. I do think the economy is slowing. We've seen that in some of the more recent labor statistics. And I think that will create the confusion that we're now in to continue. Are we done? Where's 2%? Oh, it's still 4%. Nominal GDP slowing. The estimate cuts that I referred to earlier for the fourth quarter and next year, I think will continue.
These debates haven't been settled. We'll continue the conversation. Bob Dole, Richard Bernstein sticking with us. About 20 minutes out from the opening bell, equity futures up here by 0.5% on the S&P. Let's get you some movers and say good morning to Abby.
Good morning, John. And for that move for the S&P 500, the best possible day in more than a week. Helping out, let's take a look at what's helping this bullish tone. Workday shares of the cloud company are up nearly 10% after they beat both top and bottom line estimates. They also raised their subscription revenue forecast modestly to $7.7 billion. But analysts really liking it. Price targets by many banks and firms raised, including D.A. Davidson. Foot Locker up 12.4%. Its best day since August of 2022. They put up a 37% earnings beat for 37 cents per share in adjusted earnings. And it's some proof that the strategic plan is working. Plus, they raised the full year view. They're very bullish, saying that the Thanksgiving weekend was strong, confirming some of the data that we've had recently. And then finally, GM up 10.7%. Its best day right now, I believe, since March of 2020. It's soaring after boosting their dividend by 33%. They've also announced a $10 billion buyback, the biggest ever, down
Huge.
14% year to date, John, into today. But let's see whether or not that gap's going to close.
Massive move this morning, just huge. Think about it. Yesterday at the close, $40 billion name, $40 billion market cap this morning, $10 billion buyback. 9:30, don't miss it. Conversation with GM CEO Mary Barra. Just around the corner. Just around the corner, the opening bell. And coming up next on this program, consumers buying now, they're paying later.
You have to pay the bill, right? And you talked about pay now or pay later. I think as we are saying high for longer, the bill is higher probably for the consumer than some people might think.
That conversation up next.
You have to pay the bill, right? And you talked about pay now or pay later. I think as we are saying high for longer, the bill is higher probably for the consumer than some people might think. You have still some consumers that want to spend really, as you rightly said, I think. But if you hear more that the economy is slowing down, and so far we have not heard so much about this, to be very honest, I think then the consumer will also lower expectations and react to this.
The time has come to buy now, pay later. Delayed payment options are booming, with Adobe Analytics expecting a record month for usage. Cyber Monday activity hitting an all-time high, surging 43% year over year and contributing $940 million in sales. Payments company Block saying its Afterpay platform saw a 19% increase in purchases compared to last year, with sellers on Square seeing transactions grow 47%. Katie Greifeld has the story. Morning, Katie.
Good morning, John. Yeah, buy now, pay later. It's the clear early winner in this holiday shopping season. Those numbers that you ran through just now, that 43% jump in BNPL. It also has Wall Street changing its tune pretty quickly. I want to point to Jefferies' John Hecht, for example. He upgraded a firm from sell to a hold this week. He wrote that BNPL is gaining momentum as consumers basically juggle with high inflation, dwindling savings, some of those factors that we talk about all the time. And interestingly, they're using BNPL not just for the big ticket items, but also turning to these services for essentials, including gas and groceries, which is a real sign of the times here. But that's to the benefit of these payment companies, such as Affirm, which is higher by more than 200% this year alone. Of course, that follows a brutal couple of years, but 200% nonetheless. There are a few asterisks here. It's not all blue skies. Competition obviously growing from some deep-pocketed rivals. I'll point your attention to Apple, which introduced a similar service earlier this year. You also have delinquencies rising as well, basically the pay later part of buy now, pay later. Bloomberg Intelligence notes, though, that the greater risk for Affirm and some of these other services at this juncture is actually from a volume slowdown rather than credit losses, especially as you have student debt forgiveness coming off. So we'll see if Affirm and some of these other services can actually build on this momentum that they're seeing.
Katie, thank you. I think a question for us all, is it a boom now and a bust later? Bob Dole, Richard Bernstein back with us. Bob Dole, record Black Friday, record Cyber Monday, airports packed over the weekend. What matters more, how much consumers spend or how they spend?
I think the amount is clearly important. We'll worry about paying later, as was pointed out. Look, Americans were born to shop, and if they're working, they're going to the mall and they're shopping, and that's exactly what we're witnessing. Consumer discretionary sector was the best third quarter earnings surprise, 13 percentage points better than expected. So that's where the action is for now.
For now. Richard, let's talk about the for now piece of this. Why isn't this the final fumes of the post-pandemic spending boom?
Well, John, I think that's going to depend on the labor markets. And, normally in a late cycle environment, you would start to see the labor markets even contract, if not weaken. That's not happening right now. So, income is the number one determinant of spending. Jobs are probably the number one determinant of income. So if the labor market stays tight and we continue to see wage gains, which there's tremendous anecdotal examples. Think of all the strikes and everything else that we've seen. You don't get that in a weak labor market or a weakening labor market. That's obviously symptomatic of a strong labor market. So as long as the labor market stays healthy, which I think it will because corporate profits are probably going to stay healthy, that means the consumer will probably end up being healthier than people think. Although I do love Bob's comment about Americans were born to shop. That's fantastic.
They seem to be, based on the numbers we've seen over the weekend. Bob, to Richard's point, the labour market, the labour market, the labour market. Tomorrow morning, jobless claims. I think a lot of people miss this going into the Thanksgiving holiday, but to see jobless claims drop back to 209, Bob, after climbing for a few weeks, there was a suspicion that maybe that labour market weakness is just around the corner. Bob Dole, based on the data we're seeing, the spending we're seeing, 209 on claims, maybe 218 according to our forecast going into tomorrow. But what's the argument against this labour market strength?
Well, as you point out, prior to last week, there were some questionable numbers. It's not going to be all of a sudden most likely falling off a cliff. It's going to be this number's okay. The next 2 weeks, not so much. Look at the monthly employment numbers slowing to 100,000, which is about what's needed to keep the unemployment rate flat. But up 100,000 jobs, that's way down from where we were. So it seems to me in an irregular way, the labor market is slowing. It's not weak, but it's no longer as robust as it was.
Bob, it's so difficult to navigate because the headline numbers still look pretty decent. We've just talked about record spending. There's some cracks there in terms of how the consumer is spending for that. We know about delinquencies. The retailers warned that maybe we should have some caution around what the holiday spending period could look like. Best Buy was one, Walmart another, talking about deflation. Then you get names like Foot Locker saying things weren't so bad. Stock is surging in the pre-market. When it comes to the equity call, Bob, do you want discretionary right now, or do you want staples going into next year?
I'm not crazy about either sector. Staples would be the contrarian move. Discretionary, having bought some of those opportunistically, turning around and trimming now because my view is, as you can hear, is things are going to slow.
Richard, what about you?
So John, I view this very simplistically, that one has to remember the cycle is determined by cyclicals. And so if that's true, and we think profits are going to start revving up again, going from like minus 10 to 15% to plus 10 to 15% as we go into 2024, that would argue for more cyclicality. The problem with the consumer discretionary sector is it's dominated by a handful of companies. So I don't mind consumer discretionary on an equal weighted basis. I don't particularly find it attractive on a cap weighted basis.
That seems to be your approach at the index level as well, not just the sector level. Richard, is that right? It's an equal weight S&P as opposed to a market weight S&P?
Absolutely. Absolutely. We at RBA view the market as a seesaw right now. And on one side of the seesaw, you have 7 stocks. The other side of the seesaw, you have everything else virtually in the world on the other side of the seesaw. And we think there's honestly a once-in-a-generation opportunity on the other side of the seesaw away from those 7 stocks.
When you equal weight the S&P, I understand what you're trying to dilute, remove the muscle from, and that's big tech. When you equal weight discretionary, is that just about Tesla for you, Richard, just the makeup of that sector?
Yeah, I mean, it would be probably, I don't want to name names. I'm not a stock picker, but something like Tesla, Amazon, you want to get away. I think, look, when you have 7 stocks dominating the market, John, I think it's a time for maximum diversification. However one wants to get that, whether it's equal weighting, whether it's avoiding, whether it's looking elsewhere around the world, however you can diversify your portfolio. When 7 stocks are dominating, it's a time for maximum diversification.
We'll see where things stand in 12 months. We'll catch up before then. Richard Bernstein, Bob Dole, to the two of you. Gents, thank you. As always, coming up, the morning calls, and later, GM taking steps to return billions of dollars back to shareholders. That stock is up by more than 10%. We'll speak to the CEO, Mary Barra, in about 7 minutes' time. This stock market is hearing what it wants to hear, and it likes what it hears. About 5 minutes out from the opening bell, equity futures are positive here by 0.5% on the S&P. The bigger move yesterday, though, right here in the bond market. Switch up the board. Take a look at the 2-year. The 2-year yield. Only a month or so ago, we were talking about 5.26 on a 2-year yield. Now we're all the way back down on a 2-year to 4.66. Think about where we've been and where we are on a 10-year maturity. That yield right now, currently, a break of 4.30, 4.29. Only a month ago, through 5%. Governor Waller speaks yesterday, says something's giving, and it's the US economy. He doesn't want to talk about the Q3 boom. He's thinking about the Q4 slowdown and the prospect of rate cuts in our future. That gets this market thinking maybe those rate cuts are just around the corner. That's the price action. Let's get you some morning calls this morning. Your first one from Jefferies, downgrading Airbnb to hold 140 price target, pointing to a recent slowdown in bookings. That stock is negative 0.4%. Piper Sandler downgrading Hershey to neutral, expecting ongoing headwinds from higher prices. That stock is just about unchanged. And finally, Citi raising its Micron price target up to 88, recommending investors buy the name on any weakness due to improving demand. That name is up by a little more than 1%, 76.92 in early trading. Coming up on this program, General Motors unveiling plans to reward shareholders. Massive plans, $10 billion buyback, big hike to the dividend. The stock is higher by more than 10%. Up next on this program, the GM CEO, Mary Barra. 25 seconds away from the opening bout this morning. Good morning. Your equity market positive by 0.5% on the S&P 500. On the Nasdaq, up by 0.6%. That equity market helped out big time by big moves in this bond market, encouraged by some dovish Fed speak in the last 24 hours. There's your opening bell in New York. Switch up the board and get to the bond market. Yields are lower again on a 10-year by 3 basis points. We have broken 430. 428.98 only a month ago, talking about 5%. Bang, much lower. In the FX market, the dollar showing some strength against the weaker euro. Not the trend over the previous 4 days, but back to about 109.81 on that currency pair. Crude higher by 1%, $77 and about 30 cents. About 20 seconds into the session, your equity market shaping up as follows. Up here by 0.4% on the S&P. On the Nasdaq, up by 0.6. One stock to watch at the open, Foot Locker. The retailer raising its full-year forecast. Abby on top of this one. Hey, Abby.
Shares absolutely soaring on this one, John. Heading to the best day since November of 2020. They finally put up a good quarter. It's been a difficult year. The stock is down about 38% coming into today. Lots of inventory issues, having to rely on promotions. But in this particular quarter, the third quarter, they did beat comp sales, putting up a comp sales of minus 8%, down 8% versus the estimate of down almost 10%. Adjusted earnings of 37 cents, beat by about 37%. So lots of good there. They are also saying that their Thanksgiving week very strong, confirming the data that we've had, at least for relative to online shopping and bricks and mortar shopping. And as a result, this is one piece of why they've raised the full year outlook. Now, today's big pop up 17.4%. Again, the best day since November of 2020. It may not just be outright buying. There's a big short interest on this stock, John, of about 11.5%. So this could be a bit of a short squeeze as well.
Stock is flying up 17%. What do casinos and the Dallas Mavericks have in common? Simone Foxman's going to tell you. Hey, Simone.
Yeah, well, the drama for Las Vegas Sands began after the bell yesterday. We got the announcement that Miriam Adelson, the largest owner of Las Vegas Sands shares, would be selling $2 billion stake. That's equivalent to 46.3 million shares. Subsequent filings soon made clear why. It said that Adelson intended to buy the majority stake in a sports team. We later learned from sources that that is the Dallas Mavericks, and that is the connection there. This is the NBA team that's been owned by Mark Cuban since 2000. Of course, no one is commenting on the story at the moment. But what's moving the stock here today, and we're lower by about 3%, is that the offering for this $2 billion worth of shares priced at about $44 a share. That was a 7.7% discount to the closing bell price. And the term sheet said some investors wanted a discount of as much as 10%. Of course, the company, though, going in and saying it's going to buy back $250 million worth of shares as part of this offering. Overall, though, no big changes at the company. No one's changing control. Adelson still remains the controlling shareholder, but shares have lost all their gains since late October.
The stock is down this morning by 2.8%. Simone, thank you. Let's turn to China briefly. Shares of Alibaba moving lower. Jack Ma urging employees to, quote, correct course. Ed Ludlow has this story. Morning, Ed.
Yeah, morning, John. This is a shock move. Jack Ma hasn't really been operationally involved in Alibaba since 2020. The stock is way off its 2020 pandemic high. We know about the plan to restructure into 6 individual units. That has largely been scrapped with the cancelling of the plan to spin off the cloud business. The most notable part of it, according to Bloomberg Intelligence, was Jack Ma noting the competition from Pinduoduo, the owner of Temu in the e-commerce space, and basically congratulating them for their performance. You'll remember earlier this week that Pinduoduo had a blockbuster earnings where revenue grew 93% year on year. This is a rallying cry from Jack Ma, very unusual occurrence, and puts a little bit of pressure on the 2 co-CEOs, Joe Tsai and Eddie Wu, who are trying to plot a path forward for this company that is underperformed year to date.
Ed, thank you. Pulling back just a touch. Let's talk about a name going in the other direction. Big moves from GM this morning, and the market absolutely loving it. Katie, that name up around about 11%.
Yeah, GM shares flying at the moment. Let's start with the why. The 33% boost to the dividend. GM raising its quarterly payout by 3 cents a share to 12 cents beginning next year. That's in addition to a $10 billion share buyback plan. That is the biggest ever in GM's history. You can see shareholders clearly like that. Now, GM also reinstated its 2023 earnings guidance to levels modestly below what it had before the 6-week strike by the UAW cut into profits. GM said that net income will now be between $9.1 to $9.7 billion. Previously, that range was between $9.3 to $10.7 billion. So clearly, that 6-week strike left a mark, John.
It's just amazing to see that move off the back of this plan. Some big numbers out there. Katie, thanks for that. GM up this morning by a little more than 11%. Joining us now, I'm pleased to say, on Bloomberg TV and on Bloomberg Radio, GM CEO Mary Barra. Mary, wonderful to catch up with you. Your stock is loving you this morning. We'll get into that in just a moment. I want to go through some of the numbers for our audience. Dividend up 33%, biggest ever buyback plan, $10 billion, $40 billion name yesterday, just for some context perspective there. That is massive. Inquiring minds, Mary, will want to know, why have you decided to deliver a $10 billion buyback shortly after you've signed a Labour contract that adds $9.3 billion to expenses over its term?
Well, as we looked at what was happening from a labor perspective, we had built, and really the labor environment going into our negotiations, we had put conservative estimates into our plan. So although it was a little higher than what we expected, we believe that we have, and our guidance for next year we've already said that we'll be able to offset that completely with the plan that we already had of a $2 billion cost out perspective. So we did the right thing to recognize our manufacturing team members who have done a great job and continue continue to build, vehicles safely with high quality. And we also thought that we've got to look and make sure that we're balanced across all of our stakeholders, and our owners are very important. So we think this was a very balanced response when we look at what was done from a labor perspective and what we're doing as part of our capital allocation framework for our owners.
Well, let's get into that. So shareholders are super happy. The name is up by almost 11% so far this morning. I wonder if UAW is. Mary, they didn't get the 40% they wanted. They got 25 plus cost of living adjustments and other things as well. Is the optics of this morning not something that concerns you?
When I look at it, I think it's balanced. Again, we have very well compensated, and when you look at the suite of benefits that our represented team members have, it's a very appropriate package, and frankly, leading from an industry perspective broader than just the auto industry. So I think we did the right thing to recognize and reward the hard work of our manufacturing team members across the board. But also, one of the things our manufacturing team members very much value is job security. And to have job security, you have to have a strong company, and you have to look at all of your stakeholders. So what we did from a share buyback perspective for our owners is, I think, a very balanced response.
As you know, this move this morning, not just about the capital return program, also about cost cuts. We know you're looking to fully offset that labor contract, the additional costs from it. Have you identified where you will cut, where you need to cut?
Yes, a lot of this was already underway. At the beginning of this year, calendar year 2023, we announced a $2 billion cost reduction, structural cost reduction between 23 and the end of 24. That's well underway. As I said, we also comprehended that we would have increases in our labor cost as we looked at what the environment was, and also wanting to reward our manufacturing employees. So, there's work going across many aspects of the business, and including making our products more efficient while still having the features, the functionality, and beautiful designs that our customers want. So there's been a concentrated effort at the company to lower our fixed costs while enabling wonderful products and rewarding the team that is helping us deliver them.
Clearly, these are additional costs. Are they forcing a change in execution or a change in strategy?
Definitely not a change in strategy. Our strategy is clear. It's really based on 4 pillars of executing our strong internal combustion engine program vehicles, and we see we're performing very well in the market, and we see that we're below the average incentives. I think that speaks to the strength of our internal combustion engine products. From an EV perspective, we have confidence in the portfolio we have. We're a bit disappointed this year that we were constrained by the automation to build modules. So this is not something that is fundamentally an issue with Ultium. It was more a manufacturing automation issue that we're working, and we'll be out of it by middle of next year and making improvement every quarter from that perspective. Also software. And this year, earlier this year, Mike Abbott joined our team, who brings tremendous software expertise, and he's built a very strong team that we'll share more about when we get to our Investor Day in March of next year. And then autonomy. And when you look at autonomous vehicles and the importance of this technology and the talent that we have at Cruise, we are doing an independent review from an incident perspective, but also overall from a safety perspective, and that will guide our path forward there. But we have a very capable team there. So the 4 pillars of our strategy have not changed at all. What has changed is our tactics, and our tactics are changing because the world is changing. We never thought that the EV adoption would necessarily be a straight line. We've seen this in other markets. We're seeing it now in the U.S. But I think the thing that everybody has to remember, if the growth is slowing, it is still growing. And we think as we get more of the EV products we have this year into next, we think we're going to see strong adoption for our products. And as the charging infrastructure continues to be more robust, we think that's going to drive adoption, as well as having affordable EVs. And that's where, when you look at the Chevrolet Equinox, as well as the Blazer and the Bolt that's coming, we're going to be having products in that range of affordable vehicles that is going to be very important from EV adoption.
2 things to unpack there. One is robotaxis, the other is EVs. Let's deal with robotaxis first. You're cutting expenses on Cruise substantially. Just how committed are you there? I remember only a number of years ago we were talking about bringing in $50 billion in revenue by 2030. And I get it, Mary. We all understand that new tech is tough to develop. It's hard to deploy. I think we're seeing that across a range of issues. But when do you know if it's the right time just to walk away from this?
Well, I think first of all, when you look at the progress that the Cruise team has made over the last 8 years when General Motors acquired Cruise, I think it's substantial. And we've already demonstrated that the Cruise vehicle can perform at a level that's safer than a human driver. Let's not forget, over 40,000 people on average lose their lives in traffic accidents in the U.S. alone, and 90% of them are caused by human error. What we have learned with this incident is it's got to be significantly better than a human driver to drive adoption, and we have to do a much better job of working with the regulators. That's something that GM has a long reputation of working and being transparent with regulators at the local, state, and federal level. So I think as we do that and get the results of the independent review we're doing, that will guide us on our path forward from a AV perspective.
I'm always interested in how we know when we're wrong, an exercise I think everyone has to go through, including myself, Mary. But on this topic of EVs, the slowdown, what's behind it? And why aren't we just learning that American consumers just don't want these cars?
Well, I don't think it's that American consumers just don't want these cars. I think there still is limited availability when you look at the choice that customers have today from an internal combustion vehicle perspective. I think a lot of the EVs that are out right now are more expensive. You've got to look at where the sweet spot of the market is. And when you really want to win in EVs, you've got to make sure that you are meeting the customer who only owns one vehicle. That's the bulk of people who buy vehicles today, new vehicles. They only own one vehicle, or if they have two in their family, they're needed every day to earning their livelihoods. So we've got to get affordable. There's got to be a robust charging infrastructure. So again, the growth hasn't gone in reverse. It's slowing. I think we never expected. We thought it would have some bumps along the way. I think that's what we're seeing right now. But I think when we have EVs that are affordable, when people realize how much fun they are to drive and the performance, and they're not giving anything up, and then that all-important charging infrastructure, I think we're going to see them start to grow at a more rapid rate again. And that's something that we'll continue to watch, and that's why we've changed some of our tactics to be responsive to where the customer is. You've
been super generous with your time, Mary. I just want to fit in one further question. Right now, you're a $43 billion name. It's a big move this morning by 10%. The forward multiple, we're talking about 4 times expected earnings, a little more than that after today's move. The stock has been dead money for the best part of a decade. You've been doing this a long time. I know you're super close with investors. What is it that you think is in this plan, this strategy that you have, and a strategy that you've suggested this morning hasn't changed, that's going to turn this around?
Well, I think demonstrating our commitment to all of our stakeholders, and I think when you look at a $10 billion accelerated buyback program, it should signal, because it means we have confidence in the cash generation ability of this company. We have confidence in our strategy across the 4 pillars that I covered. Yes, we had some challenges this year with our Ultium-based EVs that I think gave investors some concern. But we're demonstrating the confidence that we and the board have that we're executing the strategy, and we're going to see growth, strong cash flow, and strong margins. That's what we're going to deliver.
That's captured in today's move, up 9%. Mary, appreciate your time. Really do. Thanks for catching up with us. Mary Barra there of GM. The latest on General Motors. The conversation will continue around the equity market. Coming up, global equities poised for their best month since 2020.
This is Bloomberg's The Open. I'm Abigail Doolittle. You're looking at a live shot of the principal room. Coming up, an interview with Galaxy Digital CEO and founder Mike Novogratz. That conversation at 1 p.m. Eastern, 6 p.m. in London. This is Bloomberg.
As we looked at what was happening from a labor perspective, we had built, and really the labor environment going into our negotiations, we had put conservative estimates into our plan. So although it was a little higher than what we expected, we believe that we have, and our guidance for next year we've already said that we'll be able to offset that completely with the plan that we already had of a $2 billion cost out perspective.
GM CEO Mary Barra speaking moments ago. The automaker making its case to Wall Street, rewarding investors. The stock higher in the first 20 minutes or so of trading. Abby has more. Hey, Abby.
Hey, John. Yes, we do have GM trading higher, heading to its best day kind of between 2021 and March of 2020. Investors really responding very positively to this news in terms of the company raising the dividend by 33% to that translates to 3 cents per share on a quarterly basis, and then the buyback of $10 billion, the best ever. Now, on the year into today, GM really struggling to some degree. The stock had been down about 15%, but investors seeing this perhaps as a turnaround. Something else to think about, John, is the possibility of broadening out. As everybody's been focusing on the Magnificent Seven, investors may be looking for the next companies, stocks that can be the up-and-comers.
That's precisely what Richard Bernstein was talking about earlier in the hour. Abby, thanks for that. Waiting patiently for us to react to that interview. Sarah Hunn of Alpine Saxon Woods. Sarah, let's get into it. From an investor's perspective, just how investable are some of these names in Detroit?
Well, I think that one of the reasons that they're changing some of the capital allocation is for exactly that reason. I mean, these are relatively mature industries. Most people have a car. It's not like a brand new technology. But moving to EV, I think, is difficult. And I think that part of what she's saying is it reflects some of that difficulty, which is that for a lot of people, especially if you live in any kind of an urban environment, that charging infrastructure isn't quite there to make it simple for people to use. So you had a huge adoption for the first adopters, like you do with a lot of new technologies. And now people are sort of sitting back and saying, I'm not quite sure I want to do that. So sort of like energy, I think the internal combustion engine has a much longer tail than people would like to assume it will. And I think that trying to balance that out right now is difficult for those, especially in a high capital cost industry.
Considering that difficulty, Sarah, is this a value trap or a value gap?
Well, I think that part of, again, from our perspective, if a company is putting their cash flow on the line and saying, we're going to do this with our cash and we can generate that cash, they're trying to give you something to use as a proxy for a change in the industry. In the interim, we will pay you to wait for things to either get better. It's tough. These are deep cyclical industries, and oftentimes the dividend yield is what carries some of these companies through some of the cycles. So I think it's a tough position to be in. I don't envy her that position.
And many of these companies need to cut prices, not just cost. Sarah, let's get into that. Who has pricing power right now? And you can go beyond this sector, beyond Detroit. Where is the pricing power?
I don't think it's in automobiles. I mean, even if Tesla's cutting prices, it tells you that there's not a lot of pricing power in that segment. I think some of the technology stocks continue to have pricing power. I think even some of the consumer things continue to have pricing power. If you look at what people have done on the streaming side with people raising, there's Netflix raising their prices and saying, we're kicking everybody off of your subscriptions. So I think that there are places where people are willing to say, you know what, it's a small enough price per month. I want to keep doing that. Larger ticket items, I think it's much more difficult. So I think there's a pricing element to it. But I mean, even Apple's got pricing, and those are not small. Those are not small items either. It really depends on where you sit in the consumer's preference cascade, I guess.
Abby was talking about the prospect of broader participation in this equity market run. November's been much, much better all round. But Sarah, going forward, does some of this persist? Can you get participation elsewhere into next year?
I think that there's so much difficulty in predicting next year because there's a range of different probabilities of what may occur. If we are going to continue on the idea, which is the current consensus, which goes back to the consensus ping pong, that things are going to be fine, that we're Goldilocks and everything is going, things are going well, inflation's going to come down and we can start to see rates come down and all that will happen at a moderate pace, then you should see broader participation. If you get some of the concerns like labor is still very strong and therefore wages are going higher and margins may contract and that might be tough for earnings, I think that that's going to be a problem for everybody across the board. It's not just going to be a problem for the top 7 that we've been seeing so far. I think it really depends on how next year plays out, and I don't think that we have a real read on that yet.
You know how we typically end an interview, I talk about energy, Sarah, so let's do that again this morning. It has been tough. The underlying commodity, October, down by more than 10%. November, difficult. Energy equities underperforming. The sector on the month down by something like 1%. Does this sector need commodities to rally or just stop going down?
I think it needs them to stop going down because it wasn't pricing in the higher costs or the higher prices to the extent that they were higher in September anyway. But I think this is, again, part of that problem of what people consider legacy industries. And the idea that we're calling oil and gas a legacy industry, sort of like we're calling the internal combustion engine, when both of those things are the majority of production, both in cars and of energy, is kind of amazing. But that's kind of what happens when you're looking at different investor manias as we go through
Sure.
things. So right now, these are just sectors that are not in favor.
It's crazy, but that's where we are. Sarah, thank you. Sarah Hunt there on the latest. Coming up, your trading diary. That's next. In 25 minutes into the session, equities higher here on the S&P 500 by 0.7%. Decent day of gains encouraged by the bond market. Early days, but decent day of gains. That's the price action. Let's open the calendar and take a look at the trading diary. More Fed speak. Cleveland Fed President Loretta Mester speaking at 1:45 Eastern. 2 p.m. Fed Beige Book coming out. President Biden discussing the economy at 3:30 Eastern. Tomorrow, another round of jobless claims and core PCE inflation numbers, plus an OPEC Plus meeting. And finally on Friday, main event to round out the week. Chairman Powell speaks to close out the trading week, going into the quiet period. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.